Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Paul Ciana joins us, head of FICC Technical Strategy at Bank of America. Paul, you don't mince any words about it. This is a 2-year going well above 5%. How does it get there?
Yes, indeed. So base case technical process here says there's something called a rising wedge pattern forming in the medium-term chart of 2-year yields,
right,
which says this cycle needs to make another marginal new high this year.
What is the bet now in the bond market? Can it be like an NVIDIA where everybody's on board in an equity stock and Louis distribution because there's an oomph? Is there an oomph to the bid? Is there an oomph to a lower price, higher yield on 2-year?
I think it's driven by the commodity space. Right?
Really?
The higher commodities
You're
go.
in speaking terms with Francisco Blanche? It's unbelievable. It's
Of course.
breaking news. Commodities are driving the 2-year yield.
Yes, it's the inflation scare, right? The higher commodity prices go, the more markets think about sticky inflation, the risk of the Fed staying on hold for longer, potentially pricing out cuts, the narrative talking about whether or not we get a hike, which is unlikely, but...
Yeah. I mean, the interns today, Paul, when I came in, they didn't brief me on Brent. Brent was 83. It's now rounded up $85 a barrel. Yeah. There's that inflation.
Exactly right. And Tom, I'm looking at Paul. He's got in his research notes. There's just way too many charts, and I mean, it's just nonstop.
He wrote a book. He couldn't even get into Le Cirque across when he was at Bloomberg.
Here, right?
He had to show his ID at Le Cirque, and they didn't even believe his ID. And he had a book out on technical analysis. He was like 17 years
exactly.
old.
So, Paul, what do we do here with this 10-year Treasury? It feels like, I don't know, 450, we kind of feel like we're in a kind of a trading range here. How do you think about the 10-year yield?
We do. You know, our medium-term view here on the 10-year yield is, you know, we're in this first half of 2024, which we define as counter trend to fourth quarter 23. Fourth quarter 23 yields fell. First half of this year, yields up. I think we're nearing the end of that period where we should be looking for tops in the 10-year yield chart or signals that say we peak out by 5% and roll over in the second half of the year.
You take your trend analysis back to John Fitzgerald Kennedy. What do we learn by taking the 10-year trend back to 1962-63?
That it went up for 15 years and about down for 30.
Wow.
So that doesn't mean it can't go up for 15 years, right? Anything is possible in markets. And what I think changed in 2020 was the downtrend in yields, that secular decline clearly ended, right? The downtrend channel that everybody loved for so long, from the peak in 1985 down to the 2020 low, it broke. And I think what's even more fantastic from a technical lens is that there was a head and shoulders bottom in the monthly charts of 10-year yields when it did, in fact, change the secular tide. And, to see that happen, it complements the head and shoulders top back in the early 1980s. So these are the same technical patterns, Tom, that are formed by different investors over different generations repeating themselves.
Good point. So is this kind of is this kind of the new normal here? You know, we got a 10-year at 4%, 5%. Is that kind of the new normal here?
I define it as we're now in a secular bear market in treasuries.
Secular bear market.
Overall,
okay.
Biggest picture, right? People would say
right.
the equity markets are in a secular bull, right? In treasuries, we're in a secular bear, which is rising yields for the biggest picture. Okay. So this year, they come back down again, but maybe next year or two, they go to higher highs.
If a stock is a moonshot, and we're going to go a little technical here now because Ciana can keep up with this. If you run it semi-log where slope matters, percent change, and even if you take Wells Wilder 1978 and you look at some trend analysis as well, can you chart NVIDIA? I mean, it's outside your remit to give me buy, hold, sell on NVIDIA, right?
True.
Okay. Can you technically chart a moonshot, whether it's copper or NVIDIA?
Absolutely.
Well, what do you see now in a moonshot like NVIDIA?
Well,
is it contained? Is it
on
in control?
Arithmetic scale,
Let's
Right?
go. Lisa,
It's like an L.
Oh, whoa. Too many syllables. Lisa, can we go arithmetic today or logarithmic?
Logarithmic.
There we go.
All right, there
Take
we
it back
go.
to arithmetic. He's a guest.
Look, logarithmic scale, it's up and to the right.
Right.
If you look at the dollar since 2008, the dollar's up and to the right.
What's your dollar call?
We're bullish.
Your bullish dollar.
We think the dollar stays supported this quarter. There's potential for a breakout in the Bloomberg dollar index, for example, to another high for the year before there's any risk of it rolling over. Ultimately, the dollar isn't the trade here. It swings 3% either way. It's the currency on the other half.
Right.
So if you want carry, because that's
Brilliant.
your portfolio's...
Oh, what is this, the hour? Only Damien can talk carry here. Paul, I got time for one more question. We had James K. Glassman coming in later, iconic for Dow 36,000. It took a while to get there. Can you frame out a roaring 20s like Ed Yardeni, where we're in an extended bull market?
You know what we can frame out in our equity technical research is that every cycle that we've pretty much looked at for this year is positive. And it does indicate stronger statistics for the summer rally and stronger statistics to year end. So big picture, we do think that equity markets are in the secular bull cycle, not a secular bear. So yes, it is supportive of that narrative.
Okay. Yeah, that worked out okay.
Yeah, he knows what he's talking about.
You know, he knows where the food court is. Paul Ciana, ex-Bloomberg, now holding court at Bank of America, doing a great job there. And I really can't say enough about his book. It is not dated. It is a brilliant book, a little dense there, a pro book on technicals as well. Thank God for Amanda Lynam of Villanova, who hit the pause button in the control room and said, there, that should do it. I mean, I had that once happen where, it's like one little button in the studio and boom, it's on. Thank you, Amanda, for getting our audio back. Joining us from BlackRock, Amanda Lynam right now. We just had Paul Ciana from Bank of America. And it's in the zeitgeist, it's non-consensus, but with nominal GDP where it is, with the spirit of Atlanta GDP now, what if rates go higher? How does BlackRock and how do you, Amanda Lynam, frame out a 2-year at 5.05, 5.10?
Sure. Good morning, and thank you, first of all, for having me. I think, Tom, what you're raising is the reason why we think that there's not really a sense of urgency for the Fed to normalize policy, and even when they do, it's likely to be a shallow cutting cycle. So for corporate credit, that means we shouldn't be banking on significant near-term interest rate relief. I think the tail risk that we're watching, and the longer that rate cuts get delayed, I think lends more credence to this possibility, is that of a rate hike. And a rate hike would not be negative for credit because of the incremental 25 or 50 basis points mathematically. It would be more negative for credit because of the uncertainty that it would interject related to the forward path of monetary policy. That's not a great backdrop for credit. That's not a great backdrop for deal making, specifically kind of sponsor-related M&A. And so that's what we're watching for. It's not our base case, but it's a concern. And that's really the risk.
Sponsor-related M&A is when the kid asks you if they can go to the third lacrosse camp this summer. That's what sponsor-related means.
So, Amanda, I can sit here at a 2-year treasury like a lot of investors here and get close to 5%. That's not a bad trade. Or should I take some credit risk, do you think?
So we like taking credit risk and floating rate exposure.
Okay.
Leverage loans, for example, up around 3.5% year to date, outperforming high yield up around 1.5% total return.
Okay.
IG is lagging because of the duration exposure. I think importantly, if you're deploying money in corporate credit, you need to be deploying for income and yield, not for total return. We shouldn't be banking on a significant rally in rates to really kind of juice those total returns, nor should we be banking on material spread compression because spreads are already quite tight. So really the conversations that we're having in capital deployment and corporate credit is really about locking in those yields.
I'm going to get you in trouble. It's confusing, folks. There's BlackRock, there's Blackstone, there's BlackRock, which is the building CBS is in over, I think it's on 6th Avenue. Amanda, I'm going to get you in trouble here. If we get a rate regime higher, what does that do to private equity and private credit valuations? my math doesn't work.
Yeah. So somewhat counterintuitively, Tom, against this backdrop of high for longer, we've seen covenant defaults in one of the private credit indices that we track decline for 4 consecutive quarters, which is a bit of a counterintuitive result. It speaks to the flexibility that is inherent in this long-term lender-borrower relationship. I think the point you're raising is also applicable in the public markets. And for a given company with a given business model and a given macro backdrop of, say, higher for even longer, they're probably afforded more flexibility in the private markets relative to the liquid. However, I do think that when you're thinking about sponsor-related M&A, so again, not strategic companies buying other companies, but more LBO activity, financing is a major component of that equation.
Right.
And so it would likely keep that sort of activity muted.
On Twitter yesterday, there's a guy, I'm sorry I don't have his name in front of me, he's absolutely fabulous. I read everything he does. He breaks down all these property deals that go bust. And there's a deal that went bust, I can't remember the geography, it doesn't matter, where they took the mezzanine financing and equitized it. That's what I see coming here with a higher rate regime, is somebody puts a shotgun to somebody's head and says all of a sudden it's equity.
And I think with respect to commercial real estate, the trend that we've seen over the past 18 months has been extending. I think we've underestimated the ability and the willingness of lenders to work with their borrowers. And so, for example, Real Capital Analytics estimates there was more than $200 billion of CRE debt that was supposed to mature in 2023 that did not. So it was pushed to 2024. So now that 2024 maturity wall is not $600 billion, it's around $800 billion. If we have the environment where you interject uncertainty related to monetary policy, I think, but there may be a limit to that. I think, Tom, is the kind of the tail risk in a higher for longer rate environment, where importantly there's uncertainty, so that expectations in that price discovery process can't get met between the buyer and the seller.
Amanda, you're head of macro credit research at BlackRock. How do you think about private credit? Because that's been a business that's just exploded in the last 10, 15 years on Wall Street.
Yeah, we actually have a pretty constructive view on private credit. We're expecting it to grow at around a 15% compound annual growth rate over the next 5 years. That's actually below the 20% compound annual growth rate of the past 5. But we think it's actually a positive from the perspective of several years ago, if we were having this conversation, a company may have decided between issuing a high yield bond and a leveraged loan in the syndicated market. Now there's this third and viable option. Importantly, we also see scope for this to grow beyond corporate lending to asset-based lending. So as banks become more selective with their lending, we see actually an opportunity for private credit to step in there. So we have a pretty constructive view on it.
Are you worried at all about the maybe lack of regulatory oversight of that market? Because it doesn't seem like it's not an SEC type thing.
There is actually a fair amount of oversight in terms of how these companies operate business. I think the one stat, actually, if I had to pick one that gives me comfort, it's that new, and this is using data from Preqin, new entrants in private credit have raised 2.5% of capital on average since 2022. So it's showing that actually the market's being discerning in where it's allocating capital. It's valuing expertise, experience, governance.
We're running out of time, but a big question, particularly into the Apple meeting, is big tech finally going to grow up and issue debt?
Well, we've seen the capital markets in IG wide open, books 4 times oversubscribed.
No, stop! They make one phone call to BlackRock.
So, I mean, I think if I'm a corporate treasurer or CFO, especially if I'm in a cash-rich position, I think I would be prudently issuing in the first half of this year. There's a fair amount of event risk heading into the second half, where I think it behooves treasurers to take some chips off the table. Specifically, even though the risk-free rate is elevated, spreads are tight, the tone is good, and I think they should probably think about taking that window.
We got through this without asking her about Bitcoin.
Yeah, exactly. Good for her.
That's good. Amanda Lynam, this was brilliant. Thank you so much. She's with BlackRock.
Yep.
We're going to digress here right now, and it is into the election season and all that we have, and it is into a taut 239-page book. It is cheaper, faster, better, how we'll win the climate war by a guy who's never mailed it in. Tom, on the upper, you went to Yale and you could have been a flunky, and you weren't. You absolutely nailed it in economics. Where did, everybody knows you had the drive in investment capital, Goldman Sachs, Morgan Stanley, blah, blah, blah. Where did you get the drive the first day at Yale University to not be another spoiled brat?
Excellent.
Where did that come from?
Well, I guess you never met my mom. It's so funny.
Blame it on the mom, right?
Well, I give her an enormous amount of credit because she's one of the most down-to-earth people I've met in my whole life.
Okay.
She was, she ran school volunteer programs all over New York City.
She worked at the House of Detention, is that right?
She worked at the Brooklyn House. She rode her bike all over the city. She accepted herself, and that meant she could accept everybody else in society, from the fanciest to the least fancy, and look at them in the eye as an equal. And that's how I was brought up, and that's what I believe.
The last chapter of Cheaper, Faster, Better is the heart of the matter. You're widely perceived as a Democrat with Mondale and all of your work over the years, but you have to speak to a doubting America on climate change. When the conservatives read this book, what do you want them to get out of it?
What I want them to think is that this is a potential American success story, one that we are going to win, but we're going to win it together. I mean, the book is called Cheaper, Faster, Better, How We'll Win the Climate War, which means we're going to win it in the marketplace. We're going to win it with the cheapest, best products in the world, and that's actually how we're going to solve this crisis, but also how we're going to have another American century, how we're going to come together as a people. We shouldn't be divided on this. We should be together on this.
When Paul and I are in London, climate change, green, you're steeped in it, particularly in the continent of Europe as well. Is the reason America's behind is some Lockean individualistic ethos from 1820, or for that matter, 1720?
Well, let me say this, Tom. There is a lot of talk in the U.S., but let's look at what's actually happening in the U.S. I mean, in one of the states where the talk is strongest against the sort of clean tech revolution, which would be Texas, they've tripled their solar in the last 3 years, and it's going to go up another 35% this year.
I saw this week, Paul, an article, Texas is the most green state right now.
Exactly my point. So they can talk and talk and talk, but my point is we win in the marketplace. Texas produces by far the most wind energy of any state, by far. Why are they doing it? To be nice, to be woke? I think they're doing it because it's cheap and it's a good deal. And that's my point is, for whatever reason people do it, we need to come together on this and win. It's important for us economically. It's important for us as a people. And by the way, look at what's happening in Texas. Look at what's happening in the southern United States right now, in terms of storms, in terms of a heat dome, in terms of people dying. That's what's actually going on, and the people in Texas know it. And the question is, why don't we accept each other, accept each other's motives? We're good people across this country. We share an awful lot. We're all patriotic. Why don't we go and win together in the way that the United States is built to do?
You take a look at, I think if you talk to the average person on the street, one of the things they think about when they think about clean energy would be electric vehicles.
Yeah.
And we had a nice initial surge, and we had this great Tesla success story, which is phenomenal. But what we've seen over the last year and a half, 2 years is kind of the pulling back a little bit from the auto industry. It seems like maybe the first adopters for EVs, they're already satiated. Where's the demand going to be? That's been a concern. And now I read an article in the journal about maybe this whole EV thing's becoming politicized. The people that believe in climate change versus the people that don't believe in climate change. How do you bring those two together?
Paul, let me just tell you a story. So probably 7 years ago, one of my very best friends in the world, who I would describe as a business Republican, somebody who believes that the economy drives success, that business drives the economy, that, a traditional, moderate conservative, but a really smart guy. He bought a Tesla, and he's a car guy. He's from California. When I met him at 18, he took me out in his car and took it up to 100 miles an hour to show me how fast it could go. He bought a Tesla 7 years ago. I said, Matthew, are you out to save the world here? And he's like, absolutely not. This car goes 0 to 60 so fast you can't believe it. It handles better than the European sports car. I love this car. So in fact, cheaper, faster, better. Americans are going to buy the cars that they enjoy, the ride they believe in. And whether that's going to be, they had a bad first quarter. I think a lot of it has to do with the product offering, whether they're new products. Where everybody's talking about the $13,000 BYD car that goes 1,200 miles. Now it's a plug-in hybrid, but my point is this is going to be product-driven. It's going to be people buying a ride.
Should we ban Chinese EVs if they're so far ahead of us in delivering a $12,000 vehicle? Should President Biden's second term, you'll probably be in the cabinet, should he let the Chinese EVs into the country?
Look, I'm going to give you the argument, then I'm going to give my answer, if that's okay, Tom. Look, China is the country that emits by far the most, but they're doing everything they can to win industrially in terms of, the clean energy. They're trying to do all the solar panels, all the EVs, and they're basically, dumping into the United States. And the question is, when people offer you really good products, really cheap, should you allow them in? Hurts jobs, helps. By the way, you guys keep talking about inflation. Oh my God, the bond market. What do you think was keeping inflation down all these years? It was cheap products from overseas forcing prices down.
Fair.
So when I look at that, I go, okay, environmentally good, consumer-based good, inflation-based good, but it goes after American jobs. We have to win in the marketplace on our own.
Okay, one time for one more question. Farallon Capital 2025. There's a 40-page memo in front of Steyer, and it says, why don't we have EV charging stations on the Upper East Side? What a scandal that we can't build zillions of charging stations. Whose fault is it?
Look, as far as I'm concerned, if people will pay for charging stations will get built. The U.S. has gotten... Look, we have not been great about infrastructure, period, Tom.
Fair.
If you look about how are we doing in terms of buildings, physical things in this world, we're kind of caught up in our underpants. And I think that in this case, this is a question where we have to respond as a society. And I think from a central place, we have to say the perfect is the enemy of the good here. We need to win here. We need to solve this crisis. And we need top-down saying we got to cut through the red tape. And that's true, in virtually every part of this country.
Cheaper, faster, better. Tom Steyer here with a primal scream about the view forward on climate change. Paul, from the mail I get, hugely controversial. Your daily look at the front pages. Lisa, what do you got?
How did I miss the Dan Ives story? That's what I want to know.
You can't miss it once you see it.
My goodness. All right. Well, we're going to start with the Wall Street Journal. This is about companies' 401k match. They're saying that it doesn't provide a secure retirement for all Americans, so not everyone is the same. It's a study by Vanguard. It says that perk mainly benefits high earners, so it shows nearly half of $200 billion companies contribute to workers' 401k. It goes to that top 20%, and the lowest earning workers get 6% of the money. So researchers are saying that new formulas for company matches, they really need to be curated to kind of ensure that better benefit for everybody.
I skimmed the article. I take immense issue with it. And Peter Orszag is expert on this. Orszag, when he was at Brookings, invented this. The reason it's so skewed is the fancy people put more money into their 401k, so they get more of a match. And yes, there should be, if we agree that the retirement program is a disaster, which I feel strongly, we have to come up with legislation to allow people that don't have disposable income to get a bigger 401k and to get some form of match. But I just thought the article piled on the haves who have the cash flow to put aside and take advantage of the match.
And Social Security, you can't depend upon Social Security.
It's becoming a new worry.
Right?
Yeah. I had the privilege once of talking to Alan Greenspan about this, and I believe it was 1986 was the last time they really walked through it. And all this is going to come to an head, Lisa. It's really, really, really serious. It's really front and center. It's something Paul and I are devoted to, folks. We're going to try to do more in retirement planning here going forward, because it's a train wreck. It's tough out there. What else?
And that article really, really gets into the meat and potatoes of it. Okay, orange juice prices, we know they're soaring, right? So the Financial Times...
I didn't know that.
Yes,
they are? Okay.
Because you have a problem. You have bad weather, diseases in Brazil, and that's like the world's largest exporter. And then you had the crop problems in Florida, too, on top of it. So that's why those orange juice prices are soaring. But the Financial Times is saying that it's pushing manufacturers to think of alternative fruits. So what do you think about mandarin juice?
Sure. I like a mandarin.
I like a mandarin,
and there's
too.
like a mixture thing. I'm fascinated by this. Where you grew up, what kind of orange juice did you have?
Tropicana.
Yes.
You had a Tropicana in a paper thing, right?
Yeah, from Florida.
Yes.
I grew up where it was un-American if orange juice wasn't a lump like a hockey puck
In the freezer?
frozen in the freezer.
Yes.
And your mother would say, go make the orange juice, and she'd put it in, and then you'd stir it around hoping it would defrost over 6 hours. And then there's other people, if it's not in a bottle, they won't drink it. What is this about? But I don't buy much orange juice. It's gotten expensive.
I don't either, but because there's just so much sugar content in it. But it's happening.
All right, so what do you...
Water.
Just water.
And a vitamin C pill.
No, you eat
when she invites
fresh
us over,
fruit.
Tom, we're not going to her house for
But fresh fruit is what you eat, except it's expensive.
Yes, but the fresh fruit, you have to make sure to keep the pulp in it so you get the fiber too.
No, I'm like a minimum pulp person.
You have to get the pulp in there.
No,
Wait,
I'm not
are you
a
saying
pulp
eat
person.
the
Are you a
orange
pulp
skin?
person?
Are you eat the orange skin?
No.
You gotta do the pulp. It's where the fiber is. Come
please.
on, Paul.
No.
All right, let's turn to the Olympics.
Yes.
Oh, let's turn to something healthy.
Yes, we'll go to French fries, okay? So the New York
Freedom
Times is saying French fries will not be on the menu for the athletes of the games in France. Now, it has nothing to do with the health reasons because they're fried or anything. It has to do with the environment. So this is at the Olympic Village, which is the dining hall. They serve about 45,000 meals they're going to, 24/7. The chefs say that the French fries are too risky because of fire hazard concerns over those deep fat fryers, okay? They're also they're also not serving foie gras because of concerns of animal well-being and avocados on top of it. You cannot get those things
Why
on the menu.
can't you get avocados?
Because they're imported from a great distance and also they consume a lot of water. So that's why you can't get. What you can have French cheeses. You can have veal in like a light sauce, not a heavy, buttery,
down with that.
Okay, and baguettes, yes. But there's going to be over 500 meals.
But no frites, okay.
But yes, no French fries. You cannot have them at the Olympics.
I saw a TV 24. I actually watched the whole YouTube video of will they swim in the River Seine. And the guy, Mr. Environmentalist, he said right now he wouldn't swim in the Seine.
Yeah.
But the opening games, I believe I read the opening games are not going to be a huge arena. It's going to be along the river.
Okay.
Like a boat
For the opening?
thing.
Okay.
Yeah.
Opening
Okay,
ceremony.
Which is very cool.
Awesome. I mean, this has a potential to be just an extraordinary Olympics with the backdrop of Paris.
You and me, Hotel d'Aubusson, Rue Dauphine,
Sure.
by the shores.
Yep.
Bring Francine along to help us,
With the
order a
translate.
baguette.
Yes.
Yeah, baguette.
It's like a no-brainer. I mean, it was destined to happen. What else do you have?
Lastly, Chipotle. I always thought that they piled on the portions.
You're hitting all the nutrition
Okay.
today.
Yes, exactly.
But actually, there's a lot of people who are posting to social media. They're filming the workers who
I
are
saw
dishing out
that.
the food, and they're saying that they're skimping out on the protein portions. They're giving smaller amounts of the steak and the chicken.
Yeah.
And so now they're posting these videos to kind of give pressure to Chipotle to say, hey,
my
beef it
Chipotle
up.
on 3rd Avenue, they always do a good job.
Yeah.
They do
There's
a
one
good
in my town. They pile it on.
Oh, they do. I know that one. That's a good one. Yeah.
Can I give you the
I don't
best
know.
chicken in Paris?
Yes.
Le Coq au Fille. It's
Ooh.
up by Montmartre. Little tiny restaurant. You sit at the table with other people that you don't know. And it's like real rotisserie. And the secret is they use big birds. The secret. And they,
Not Big Bird. but
no, not big
Big
birds.
birds.
But they use a bigger chicken than most people.
A bigger chicken.
You got to get a reservation like 3 weeks ahead.
Well, that's
Really
no
worked out.
good.
And they serve French fries.
They
and
do.
For dessert, they have Chipotle.
Yes. Win-win.
So I see a theme
Lisa
here today.
Mateo,
with her
thank
food,
you.
going through the menu.
Thank you for the
All through it.
newspapers today.
Yep.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.